Okay.
Everybody, I hope everybody's having a good day. It's Alex Blume, the CEO of Two Prime. I'm just gonna give a minute or two for others to filter in, and then we will kick it off. But welcome, everybody. Just give us 1 minute. All right. Well, I think we can get started. I think others will be joining in a bit, but I don't want to hold people up. So, everybody, welcome to this Two Prime and BitGo webinar about Bitcoin-backed loans and the risks and opportunities within them. I'm really excited to join you. I'm Alexander Bloom, the CEO of Two Prime. If you're not familiar with Two Prime, we are a Bitcoin financial services business. We're a registered investment advisor and commodity trading advisor. We work exclusively with institutional clients, including 11 public companies and great parties, counterparties, and partners like BitGo and other similarly regulated entities. So really excited. We're one of the largest Bitcoin-backed lenders in the world, with some other exciting loans on the horizon. And the way those loans gets done have really evolved for the time we've been in the market. So I'm excited to share with you what we know. And I'm also glad to have Steve from BitGo on the call here as well. So, Steve, do you want to do a brief intro about yourself and BitGo?
Yeah, thanks, Alexander. Steve Scott from BitGo. Been at BitGo about 4 years, working on the institutional team here on the sales side, covering hedge funds, asset managers, ETFs, and broker dealers across the platform. Sure you guys are aware of BitGo, but we are a global digital infrastructure company. We offer custody, trading, staking, lending solutions to clients across the globe and try to keep their assets safe and secure while allowing them to do things like tri-party and other types of structures, digital assets.
Awesome. Thanks, Steve. So, just so you know, for this call, this webinar, first 15, 20 minutes, I'll go over some of the ins and outs of loans and trade-offs and things to consider. And we'll turn it over to Steve on the BitGo institutional side and ways they work with loans to mitigate risk and make it a better experience. And then at the end, if there are questions or ideas or things you want to ask us, there'll be 5 to 10 minutes at the end for that. You should see, if you're a participant, a little chat box where you can log questions at any point throughout this call, and then we will get to them one by one at the end. So, with that, again, thanks everybody for joining, and we will kick it off. So, the topic of the webinar is Bitcoin backed loans. What borrowers get wrong? I'd say at the start there are the rates of loans. People look at, oh, the rates come down, I'm getting the best rate or the best LTV. But there's a whole lot underneath the hood that determines that rate, and there's a lot of risks and different trade-offs you can make when you're getting into a Bitcoin-backed loan. I think that it's not an apples to apples comparison, and not all of them are created equal. Um, and that's not to say there's a single loan type that is correct for everybody. There are reasonable trade-offs for different kinds of borrowers in the market. For example, if you're borrowing $100, probably a little bit different set of requirements than if you're borrowing 100 million. And so, our end, we typically touch more of the institutional side of the market. So we have a lot of experience there. But the point is not to say there's only one correct way to do loans, but rather introduce different considerations. So we Two Prime first got into lending because in 21, 22, every major lender in the industry went bankrupt. FTX, Three Arrows Capital, BlockFi, Celsius, Voyager. And it ultimately came down to, where was the collateral? Where was the Bitcoin for these loans when things went wrong, and how was it managed, and how was risk controlled or not controlled? And so I think people have learned a lot of lessons in the past, and we've seen that a lot of people are starting to ask different kinds of questions, but the pain from that past cycle is still being felt. Bitcoin-backed lending and digital asset lending is having a second act. It's more conservative. There's a lot more detail paid to custodians, risk management, co- um, different promises being made from different parties, and the way the larger entities are managing a risk book across duration and sizing, concentration limits, all sorts of stuff. And rehypothecation being one of the biggest questions and serious things that has changed and something that needs to be considered. So as I mentioned, there's tens of billions of bankruptcies as a consequence of last cycle. FTX and Celsius, Genesis, BlockFi, they kind of represent different sorts of risks that all conspire to create a bad outcome. With FTX, it was just pure fraud. Celsius, similar, of just using people's money in ways that they were not allowed to do. In the case of Genesis, they had very high concentration risk, exposed to just a couple counterparties who, Three Arrows Capital isn't on here, but we're committing fraud and providing fraudulent numbers or using the same collateral as backing for multiple lines of debt at the same time. And then I think in the case of BlockFi, they, as a venture-backed, fast-growing company, had a lot of pressure and impetus to grow margins. And so we're doing rehypothecation of their Bitcoin in ways that probably were not advisable. And the consequence was not just the tens of billions of money that was actually directly with these entities, but the backlash of the whole market falling, years of setbacks, reputational harm to the industry, and a lot of lawyers getting paid a lot. So the number one thing that I think has changed across the lending space from the previous cycle is the tolerance for most for rehypothecation is very low. Uh, Previously, for example, with BlockFi, you'd send them Bitcoin, they would lend you dollars, but then they would go re-lend your Bitcoin and get paid to lend that out, and they were not sharing much of that money with their clients, but it was a way for them to make an extra couple of percent so they could grow profitability and margins, especially with Bitcoin as a bearer asset. There's really if something goes wrong, there's not a lot of ability to get back what was yours. Whereas if I gave you my car to take out a loan, it would be hard for you to give away the car without a lot of legal processes and people understanding who owned the car in the first place. And I'd be able to trace down where that car went based upon the VIN number and other aspects of that loan. And so in the case of Bitcoin, yeah, as we all know, if you lose your Bitcoin or you get hacked or there's bankruptcy, you can't just say, oh, this part was mine. And, it's a bearer asset in that sense. Um, so I think people are asking a lot more questions around where is my Bitcoin staying? And I think especially on the institutional side, there's a lot less tolerance for anything other than custody where the Bitcoin can be verified and stays in a single place throughout the duration of a loan. What this means in practice is the margins on lending are um, less than they were before, but the upside is, even in this downturn the last couple months, so 6, 9 months, you haven't seen major blowups. One example is Blockfills, which was had filed for bankruptcy, but they were not a major player in the industry. The largest lenders have not had major defaults or bankruptcies despite the pullback. I want to say that, rehypothecation by itself is not inherently bad in all cases. This is what banks do. They relend money and they earn a spread greater than what they're paying to their depositors. And they manage that risk. They have different durations of loans. They have different concentration limits. They have different kinds of asset mixes of different liquidity. However, in the case of banks, there's a broad set of regulations, including Basel III, which dictate exactly what that needs to look like. Sometimes those things get modified, but this is, literally centuries of trial and error that has come to the places we are now. And still, banks lose money and make mistakes. However, a lot fewer, I would say, as percentage than what we've seen in the Bitcoin space. And the other thing is that banks, well, BitGo is a bank, but specifically for Bitcoin lending, it's a single asset. So things like diversification, concentration limits, liquidity differences, different kinds of asset mixes are much harder to achieve because you only have one asset. And so, I want to say that there are ways to lend assets out and relend assets out, and it gets done all the time. It's just that there is a strict and high level of risk management that comes with it that we often, at least in the past, haven't seen with Bitcoin-backed loans. What are the consequences of getting involved with a bad loan in the sense of, your lender fails? Well, one is there's a default. So now rather than getting your Bitcoin back, you're stuck in a bankruptcy situation, which will take years. Lawyers make a killing. The lawyers make the most money of all of this. I think there's very few protections for companies and creditors against lawyers. If you look at, FTX, these others, the amount of money these groups have made is obscene. Um, and it will take years. Often, these loan structures and these entities are structured across the US, but also foreign jurisdictions. So you're dealing with a mix of different regulator and jurisdictional processes that can be very complex and difficult to deal with. Um, Depending on what size your loan was, in most cases, people are just a general creditor. So you're just piled in with a lot of other people. If you don't follow along and take certain actions, you can often even fail to get your claim that you thought was due to you. And often, because a lot of these creditor information is published, there's a lot of fraud and attempts to email people and get them to put in their wallet into places it shouldn't go. I know my mom, who was a BlockFi creditor, was getting like 5 emails a week from people pretending to be the bankruptcy court and different kind of cybersecurity groups. And it was just fraud, fraud, fraud to the point where when the real emails came, she wasn't sure what they actually were. And then what we saw also in BlockFi, in the case of others, is that even a good outcome which is somewhat rare, where the actual creditors do get money back, is denominated in dollars. And so Bitcoin, by the time this had recovered, had 2 or 3x, but the dollar amount assigned went back to when the bankruptcy occurred. And so, yes, money was recovered, but had they maintained Bitcoin exposure, you would have had a lot more in the end. So, when groups are rehypothecating or when you don't have strong protections in your loan, you're basically taking equity style risk. You're betting on some kind of risk you may or may not be aware of, but you're not getting any of the benefit of that risk. The counterparty or the lender or somebody in the mix is capturing that difference, and you're the one paying for it. And when the consequences are poor, you're the one that pays for the mistakes. So there's no need to do that anymore. I think there are very viable and reasonable ways to protect your assets that don't require not asking any questions. And that being said, I'll mention, for example, like Ledin, a retail person that deposits to Ledin, they are giving the Bitcoin to Ledin, and then Ledin is taking on a lot of the responsibilities and entering into tri-party agreements. This is technically rehypothecation. However, there are groups that, and I have no direct stake in Ledin. I don't work with Ledin. I'm just telling you, I think that they've managed risk in an intelligent way where, retail people probably aren't going to set up tri-party custody loans and give money and fill out ACAs and have lawyers, edit MLAs. But you can work with groups that have the institutional scale for retail as well that can offer those protections. So, what do institutional loans actually look at? So, to begin with, there's the headline rate. I think if you look in the DeFi space right now, rates are very, very low because basis trade on assets has gone down. The whole market's depressed. There's a lot less speculation and volume as everyone turns to AI and SpaceX IPOs. There's just liquidity that's left the system. The consequences of the issues back on October 10th of last year also wiped out a lot of speculative money. And so what you see is, especially on the DeFi side, but across everything, loan rates have come down. But I think that there's a tendency to think that's all that matters. However, there are many variables that go into a loan that dictate that rate. Just DeFi versus CeFi is inherently a set of trade-offs where you're taking technology risk with companies that have less, in many cases, regulatory responsibilities, or sometimes there's not even an entity necessarily involved. There's a smart contract. At the same time, you have probably lower rates, more flexibility, quicker liquidity. There's also on a loan, with DeFi, there's no AML KYC in many cases. And who you're interacting with can be unknown. There's also typically requirements sometimes with Bitcoin to wrap the Bitcoin into these wrap products. Coinbase has Coinbase BTC, there's Circle BTC now, there's WBTC and many others. There's a fee to that as well, wrapping and unwrapping that isn't in the headline rate. Where that Bitcoin gets custodied is also a major question. There's cost to robust tri-party custody, which is what I would say the most secure version of how to do these loans. And it's not nothing. It's 10, 20, 30, 40, 50 bips in many cases for that kind of protection. Um, the actual legal agreements, what protections are written into those MLAs. We spend weeks or months negotiating every legal term in an MLA, an ACA, an account control agreement. MLA is master loan agreement before a loan gets done. And so if you're not negotiating that stuff, yeah, you have a cheaper loan, but it's because you have a lot fewer protections. The duration of the loan, if you have a loan that's an open term versus a loan that's 5 years, which doesn't really exist in Bitcoin, you'll pay a different amount. The longer the duration, the more expensive the loan tends to be. There's also fixed versus floating rate. Does the rate move with something like the federal funds rate, or is it a fixed rate guaranteed over a certain period of time? We've seen that institutions want a fixed rate because they need to be able to predict what their expenses are going to be over the long term. But many of the largest lenders in this space offer floating rate loans. And so um, you can see some mismatches there. Simply the management team of who are the people in charge of your money and your loan? Do they have a background in any of this? Do they have any experience? Do they have a track record or anything that points to the fact that they're not going to screw up? Another question is the balance sheet of the group you're working with. If you're borrowing, let's say $5 million dollars and sending in $8 million dollars of Bitcoin, well, if the group has $10 billion, dollars, I think you can feel maybe a little bit safer than if they have $1 million themselves. And so the balance sheet is a question. And then the tax treatment of your loan can also be, depending on the way it's structured. For example, if you're transferring title of your Bitcoin, that can create effectively what's considered like a sale of your Bitcoin, where you're going to have a capital gains consequence. Or if it's retained as your own Bitcoin that's being used as margin for a loan, it's actually advantageous tax situation where you're paying a business expense or a personal expense that can be written off. And so the structuring of the loan matters a lot. There's often cases as well where, we've created whole SPVs for single loans to keep the risk and counterparty exposure to a minimum so that groups can feel like their loans aren't mixed in with other loans or that there's risks they're not aware of. So I'd say the most robust, most secure way to take out a loan is a tri-party loan. This is probably not going to make sense for very small loans because the amount of effort, expense, and for both the borrower and the custodian and the lender is going to be quite significant as compared to something like a retail loan on DeFi or with a group like Ledin. However, it is the most secure. In a tri-party loan, the way it works is the Bitcoin used for the loan actually stays in your own account at a custodian. The lender is what's called a secured party, so they can view and access that loan collateral. And then the custodian, like BitGo, for example, sits in the middle and mediates that loan. And so they fill out what's called an account control agreement. Maybe Steve can get into this a bit more when he speaks, but that mediates the terms of when Bitcoin could be released to the lender in the event of a default, which can be defined in this ACA. And you have a third party that's neutral, like BitGo doesn't make more money or less money because of a specific loan outcome. They just sit in the middle and try to keep things orderly. And so there is a level of trust, especially BitGo as a chartered bank should give you some security. And so in this model, you actually still have the Bitcoin in your own account. You can't withdraw it without certain conditions being met to satisfy a loan, but you haven't actually given the Bitcoin over to anybody. It's important to understand what a qualifying custodian is. This is a US legal term defined under SEC Rule 2064-2. And it's very specific. There's either banks or trust companies. There's state or federal trust companies, as well as chartered banks. There's registered broker dealers. There's registered future commission merchants. And there's certain kinds of large foreign financial institutions that meet the standard. The basic idea is these are heavily regulated entities that have a lot of consequences if they do anything outside of what they're supposed to do with somebody's assets. And they're regulated and overseen in a way where you can have strong faith that they should be doing a good job. It's not a guarantee. Nothing in this world is a guarantee. I believe, for example, Prime Trust was a qualified custodian that ran into issues and has their own legal issues now. But it's about as close to safety as you can get in a world of imperfect safety. What's not typically a qualified custodian is an exchange, a wall provider, any DeFi protocoler, or lenders where you give the assets over. Even though we are a branch office of a broker dealer, we wouldn't serve as both the lender and the custodian of a loan at the same time. And I think increasingly that's what we're seeing in lending and the crypto space in general is segmentation across different functions within a loan: the servicer, the lender, the custodian, the capital partner, a backup servicer. Increasingly, these should be separate functions. It shouldn't be that one group does it all, where you don't have much protection anyway. Another very important consideration for a loan is the loan to value ratio. So the idea here is for every, let's say, $1 million of Bitcoin you put in, how many dollars of US dollars can you borrow against it? There's both the loan to value at the start of a loan, and then what's most significant is the margin call level loan to value as well as the liquidation level. So there's a level where we start the loan, you give me a certain amount of dollars against my Bitcoin. But then the more important level is the margin call, where if the price of Bitcoin drops and that ratio gets more extreme, you're going to be forced to take action to send in Bitcoin or send in dollars to get the loan to value ratio back to where we started. That margin call trigger usually gives you a certain period of time, 8, 12, 24 hours to satisfy the margin call. At the same time, there's a level even lower if the price of Bitcoin keeps going down, where there's no time given, that if the ratios become too extreme, and then the loan can be liquidated at any time. Um, so I think people look at how much money can I get at the start, but the big question you should be asking is at what price or at what point do I start running into margin call issues where I need to take action or my loan can get my loan can default. I think also this is, well, we'll get into it a bit later actually. So it's subjective what conservative and moderate and aggressive is, but basically the lower LTV you commence with on a loan, the more buffer you have before you run into a margin call issue. Usually we see margin call happening around the 80 to 85% level. And so if you start at 30%, Bitcoin can move 55% down before you um, run into a major issue. If you start in the middle, you have a little less buffer. And if you start aggressive, even less. And so part of it just depends on how much other Bitcoin do you have? How attentive are you to this stuff? Or do you want to set it and forget it? Or are you okay with servicing a margin call? What we know is Bitcoin is volatile. Our end at 2 Prime, we've done back testing of at different LTV levels, how many margin calls would you run into over a year? How often would those statistically get liquidated versus get serviced properly by the borrower? And I'd say nobody wants margin calls. Nobody wants to liquidate a loan. It causes stress and complications for everybody involved. And so it's better to be conservative. What do you do if there is a margin call? A quick drawdown can happen. In Bitcoin, you should assume that it will happen, and you shouldn't just hope that everything Bitcoin's going to go up forever. It doesn't go up all the time, every day. Ways to deal with that is one is just have more Bitcoin available. We work with institutional borrowers where they're borrowing $100 million, but it represents 5% of all the Bitcoin that they have. And so if there is a margin call, they're perfectly capable of sending in more. We do see some groups using derivatives, options, futures to hedge downside risk. This comes at a cost, especially when Bitcoin's down. The cost for puts and short futures is very expensive, where the headline rate again of the loan would be a fraction of actually what the hedging costs are. If the dollars that you are borrowing for the loan are easily liquid or something that you could take out of somewhere else and return back in the event of a margin call, that might be a way to solve it. And then I think an important one is also the relationship to the lender. On the more retail and DeFi side, you're not going to get a phone call to say, hey, where's the money? It's just is automated smart contracts that liquidate your assets upon reaching certain statistics or certain ratios of collateral to borrow. With more institutional relationships, you know, you can make a phone call and there's a human being that you can say, hey, I just need 2 more hours. I know I'm a little late, but here's what happened. And there's an element of trust that makes the loan more expensive, but also adds more protection. So To avoid, rehypothecation, what does that really mean? It means that your Bitcoin is in a segregated wallet. You can observe where the Bitcoin is, and you can observe that it hasn't been moved or reused for some other purpose. In the case of some custodians, they use an omnibus wallet structure where they, as a qualified custodian, can provide you with documentation or statements that reports on your Bitcoin without you being able to, unfortunately, observe it in its own wallet. But in many cases, you can't have it in your own wallet. And I think that in general is preferred if you can get that. The custodian, the third party, neutral party, them attesting and reporting on the Bitcoin and the health of the loan is a source of comfort that your Bitcoin is where it's supposed to be. The tri-party agreement structure we covered before also should provide comfort. It's literally still in your account. And then, within an MLA and ACA, it should be heavily documented where the assets go, what they can or can't be used for. In the case of no rehypothecation, the answer should be nothing. But that should all be well documented in that as well. So just kind of to reiterate, but these are the documents in an institutional, highly secure loan that get filled out that costs usually tens of thousands of dollars of legal fees and many weeks or months of work to complete. But there's the loan agreement that has the specific terms of the loan. These loan term sheets or loan agreements often refer to larger MLAs, master loan agreements. So there's the term sheet and then there's the master loan agreement. So the master loan agreement has every consideration of loans and what can go wrong and different policies for how those things get treated and different definitions. And then there's the term sheet that defines the specific terms of a specific loan and refers back to that. There's the tri-party control agreement, often called the account control agreement. So this tells BitGo how to behave in different situations and what documentation and what conditions have to be met for a default or a conclusion to a loan. If you're in a tri-party loan, you're going to also have a direct lending, onboarding, and loan relationship to the custodian. That'll be a different agreement. And yeah, the pledge and security agreement as well as margin schedule would be found in part of the MLA and term sheets as well. So in conclusion to my part of the talking here, I think people are asking very surface level questions around what's the rate? How fast can I get the money? What's the LTV? What's the maximum amount I can borrow? Can I get more money later? What happens if I'm late on a payment? And really, we should be asking a lot more about where is my collateral actually sitting? What are the conditions of who can sign or move assets out of my wallet or where my Bitcoin sits? What are the margin levels and cure periods for a margin call? Is rehypothecation possible in any situation? What is, even lenders, they have money coming from somewhere else. Often it's not always balance sheet direct money. So is that money under the same conditions that you're borrowing against? Are you blended in your loan with other people's loans so that a default somewhere else could negatively impact you? What's the legal structure and jurisdiction of the lending entity? And what would be the procedures of a bankruptcy? Is it a bankruptcy remote entity, or are you going to get wrapped into a bankruptcy for the rest of your foreseeable life? So we see DeFi and TradFi melding in many ways, both the rate, but as well as different practices for managing collateral, for sending automated notifications, for custodying the asset. Those things are starting to impact each other. We're seeing more sophisticated loan structures that offer margin call protections or some attempt to generate a yield on the Bitcoin while having it used as collateral for a loan. There's different kinds of durations of loans. Right now, the yield curve doesn't really go out beyond a year in most cases. You see very few loans with a greater than year term. I think that will change soon as well. And then, like I said before, greater segmentation across the custodian, the servicer, the originator, the capital provider, so that there's checks and balances and not a single group providing, 8 different functions with no accountability. So in conclusion, for me, lending should be a very boring thing. All these documents is what makes it boring. So there's no confusion or lack of clarity around how to treat a loan when things happen, which they inevitably do. So with that, I will turn it over to Steve.
Thanks, Alexander. Maybe we just jump onto the BitGo as a glance, one to kick off. But high level, just to give some details on BitGo, because the main thing that's really going to matter here is who the counterpart is that you're dealing with. When you want to come in and do tri-party, the most important thing is the safety of the assets. I think, as Alexander said, it's the boring part that really matters and what people really focus on, keeping those assets safe in custody. So just on the history of BitGo, we've been operating since 2013, started as a wallet service company. And in 2018, I think the firm realized that there was a gap to really start becoming what we class as a custodian in the industry, and there needed to be a digital asset custodian. So phased into becoming a digital asset custodian, been doing that now for around about 8 years, and have grown to be a large custodian here globally. I think two of the milestones that people really looked at to choose BitGo is end of last year, we became a federally chartered OCC trust bank here in the US, so the highest standard of regulation, which is very important for clients and making sure that we follow the procedures, etc., that's required. But also at the beginning of this year, we became a NYSE listed public company, so clients can review financials and see quarterly reports, etc. So what do clients look for when they're looking for a custodian? There's a few things that they really focus in on. What you can do across the product, obviously. We service globally, so we can face European and Asia, US-based clients. They also look for things like, what's the insurance policy like? Very, very important within digital assets. We hold a $250 million insurance policy from Lloyd's of London. So clients focus on that, want to understand how that works on the platform, and then making sure we have the audits and the proper procedures that comes with our SOC 1 Type 2 and our SOC 2 Type 2s. So we're at our peak, I think it was $100 billion of assets under custody, looking at around about 1,900 plus of different coins and tokens on the platform. We do the most amount of layer ones here in the US for a qualified custodian. So we generally can service people across the board in what they need to do. We obviously help, two prime example, solely on Bitcoin, but we can go far beyond the curve where it's required. Just on the tri-party collateral management side of things, if you want to jump into that one, Alex, and we'll sort of go into that. What's the real focus here, and why do people do it? It's exactly to segregate collateral away from counterparts, in terms of not having the collateral kept with the same counterparty that's doing the lending transaction, the derivatives transaction, keeping it in a bankruptcy remote, federally chartered trust bank is what clients expect. We've seen, I think, post FTX back in 2022, when that happened, there was a real need in our industry to build something that, TradFi saw as a very traditional product that they had, but there was very limited options here in the digital asset space. So it was obvious that something needed to be done, and we built that out over the last 4 years, and now partnered with secured parties like 2 Prime to really provide that basic safety and security, and clients get that comfort to go and create their wallets and hold assets. So what type of clients and lending desks do we face? I'd say the first thing is lending desks are probably the largest part of the business. So anyone that's coming and looking for Bitcoin-backed loans, or it could be loans in other assets, they come in to deposit their assets. Derivatives desks are very popular, as well as potentially exchanges. Putting up initial margins into the platform is also very useful. And then I would say the third one is locked tokens, vesting tokens, and/or staked assets are also things where people want to gain loans on, leverage on, etc., and look to have a custodian to hold those assets for them, safety and security. The asset coverage for us, whatever we do, generally on the platform as regular custody, we can do in our tri-party. We can do everything on the UI. We can do everything in API. Both are interchangeable. But really, from an asset coverage standpoint, if we can custody it and a lender wants to do something on top of it, that can be done on the platform. So what does it look like from an onboarding standpoint? How do we work with the pledgers and the secured party? The real focus is on the pledger. The pledger is the beneficial owner of the assets, as what Alexander was saying. So what does that look like? It looks like they have to come on the platform. They have to go through the KYC process to become a trust client. They have to sign up with a custodial services agreement that will give them their regular custody accounts, which they can use to do regular business with. And then they'll come in and say, okay, I want to partner with 2Prime and get a Bitcoin-backed loan. We will work with them on an ACA. So usually someone like 2Prime will have a default ACA that they will work off that will make life a little bit easier for clients to really start working and negotiating. Because as Alexander said, a lot of this is legals and redlining documents. So the faster we can do that for clients, the better. They come on, we basically do the ACA. The ACA opens the account, which is a separate custody account that only the assets that are kept in that account are governed under that agreement. So the ACA is a defaulted, standard kind of agreement across the street that most legal teams will know. But we can make those terms specific to the requirements of the lender or of the pledger. BitGo's role in that is really just to make sure we operationally can do it and we legally can do it if we need to. But we're open to working with both counterparts on how we actually implement that on the platform. Once the pledger has an account as a custody relationship, we can spin up ACAs very quickly. They can be open in a day or so. So we can move fast if we need to have loans opened quickly on the platform. That's more than achievable. For the secured party, it's a little less work there because we work with them a lot. They may have many different clients on the platform. For them, it's really just a simple onboard, and then they have access to be able to view and see those assets on the platform. So what does the ACA do? It basically tells us, BitGo, what to do on a day-to-day basis, and what we also need to do in a default situation, who we listen to, how that ordering would work on who we listen to. BitGo's not here to mediate, arbitrate the actual transactions. We're really here to follow the instructions, right, and make sure the assets are leaving in the way that they're supposed to be leaving, and that we're following the procedures through a default. So in the qualified custody section that Alexander has up, the first thing we have 7 different global entities and regulated trusts. So if we're facing someone in MENA, we're facing someone in Asia, we're facing someone here in the US, we have an ACA for all those. So we can take care of that across the platform, and clients can get a very similar feel across the product when they're across regions. And everything we do is out of our qualified custody, totally offline, cold storage, bank grade vaults. So there is no in the cloud, warm wallets, hot wallets. It's purely offline. And as Alexander said, it's meant to be boring, and it is boring. Getting those assets and moving is really coming out of the cold storage, because in these types of lending transactions and even with derivatives, collateral doesn't usually move that much. With derivatives, it's more around variation margin. With lending, it's more around top-ups that are required for actually moving in the LTV on the platform. So if you just want to move on to the next one there, Alexander, just on the what do the clients really focus on when we start speaking to them? It's really around, once we're past the security element, it's around the controls of who can do what, when those things can happen, and how fast we can move in terms of making sure it's through a UI, making sure it's through an API. But people really want to be checking audit streams, making sure they understand how things are moving, where things are up to, and when they're going to get their assets. So in a day-to-day process, everything's viewable in the UI. Everything's set up for clients. So there's bilateral approvals for any type of movement that comes off the platform. So if a client wants to move assets off, 2Prime would need to approve it in a day-to-day transactions, and then BitGo will allow it to leave the platform. So those are governed by what we have a policy engine, which is set up, and that is defaulted across the platform. We can work with the individual counterparts, and it's very flexible. If you want to have 2 approvers, 3 approvers, approvers from different groups, we have a lot of variations that we work with clients in being able to set that up. And then we also work with them about who can do what. Do we have someone that can only spend on the wallets? Do we have someone that can approve? People that can only view? Who's going to have API access? We make that so it's very available for clients to be able to see on our platform what they need to and get that into their administrators, into the right people within their firms. So clients really focus on that. And then you've got that sort of event that we don't want to see happen, which is a default event. As Alexander mentioned, maybe you haven't met the cure period, or assets need to come off the platform. Then it moves into, what does the ACA say? What's the default event look like? BitGo can move quickly on that once we have what we call an exclusive control event or a pledger event, depending on who actually defaults in the transaction. And then BitGo will allow that to be changed so that there could be a unilateral movement on the platform and assets can be moved off the platform. I think Alexander mentioned earlier that you could have the concept of an omnibus wallet, or you could have the concept of a segregated wallet. BitGo allows both on our platform. Both are cold storage, both are bankruptcy remote, all are insured. Different clients choose different wallet types for different reasoning. And we can go into how that looks, but essentially one of the big requirements that clients may have is being able to move assets very quickly across counterparts within our trust infrastructure. And we have basically a network called our Go wallets and our Go accounts. So that's basically an inter-company network that allows clients to offline or off-chain move assets around. So some clients choose that. Other clients move it purely on-chain and have BTC wallets, which we allow clients to do. We are open to both on the platform. So maybe just click into the next one there, Alexander. So maybe let's talk a little bit about BitGo's trading capability. So this is really something that obviously we offer across the board. There's two things. Obviously, clients want to trade either through the UI or through the API. I think we have about 100 pairs now that you can see online that we can trade. If there's something to do with two prime and there needs to be a liquidation of the assets, as long as both counterparts and an ACA agree that can occur. We can set up trading rails in ACA so that assets can be liquidated. Some clients ask for that, or some secured parties ask for that because they want to get themselves back from the Bitcoin exposure into dollars quickly and mitigate risk while they're waiting for a signing to happen and those assets to come off platform. Others ask because they could be bringing in dollars in the first place and moving into another asset and using that asset as collateral. For us, we are agnostic to all that. We just want to make sure clients have the feature to be able to do that on the platform. Just kicking on to the next one there, Alexander. Similar thing. While Bitcoin doesn't have staking on that actual product, we do offer tri-party across many chains. We have over 30 chains available for staking. Once again, we will allow staking only on the basis that both counterparts agree to do it. Obviously, there's more risk once an asset is staked. That's usually around the unbundling times that happen, especially in things like Ethereum, where it's a variable time. Those are things that can mitigate. But some clients will want to obviously earn rewards and continue to earn rewards while they're on the platform. We also have other clients that want to post something like money market funds on the platform, which are tokenized, which we can also put up for clients. And just lastly there, we spoke about the Go network settlement. That is coming out of our omnibus structure. So this is useful if you're facing maybe LPs or someone on the platform and you want to actually move those assets off-chain very quickly. Then you can make a settlement rather than an on-chain move. And that can be done 24/7, 365 real time once both sides approve the transactions. So it helps you just manage the counterparty risk, take that away from having to wait for on-chain transaction signings. And it's a very broad network of different sort of counterparts that you can use on the platform. But when it comes to Bitcoin, if you want to move things, to a external wallet, all of our walleted can do outbound external transfers across the Bitcoin network. And usually those transactions can be made within under an hour out of cold storage. So 24/7, 365. So clients find that more than ample to meet their needs to get assets off platform and back to their external wallets or potentially to another wallet within the BitGo ecosystem. So I think that's very high level about the ACAs and how the product works. We're happy to probably take questions there, Alexander, and go from there. Sorry, just on mute there, Alexander.
That helps.
No problem.
Thanks, Steve. Uh, Here, if you want to contact either the Two Prime team or the BitGo team, there are emails info@twoprime.com and bitgoprime@bitgo.com. Um, and we have about 15 minutes, but I don't see any active questions. Does anybody have any questions they want to post in the chat? Um, if not, Steve, say thank you for taking the time. I think some of these details of how these loans gets done is not as exciting as getting the loan for many people. However, it's critically important, and the partners and custodians and protections you have in place can make or break outcomes. So, with that, I think that we will wrap it up here, unless Steve, you have anything to add.
No, all good. Thanks for everyone for attending. And any questions, please reach out to myself or Alexander.
All right. Thanks, everybody. Have a great day.